They were trying to destroy our dollar. They were going to say, they wanted to create a new currency. They probably wanted to use the yuan, China.
Realize capitalism didn't change China. China changed capitalism.
I think that's breaking up very rapidly. We said that if they're going to go and do anything to undermine the dollar, that includes China.
A lot of time, most of the people are up here now don't remember. I was very young, obviously, at the end of the Cold War, but it's been about 30 years. In our hemisphere, largest country in the Western Hemisphere south of us, cut a trade deal with China. They're going to, from now on, do trade in their own currencies, get right around the dollar.
When a currency starts to settle oil, replace dollars in trade, and builds its own payment highways, that's not just economics, that's power. And that's what China's yuan is doing right now. Less than 15 years ago, almost none of China's cross-border trade was in its own currency. Today, more than half is. Saudi Arabia, Russia, Brazil, all use yuan for trading with China. And in Europe, Hungary just issued the largest ever sovereign yuan bond. Now, this isn't a marginal shift. It's the beginning of a parallel financial order, one where Beijing is installing the plumbing infrastructure, setting up those swap lines, clearing banks, digital currency networks, and the yuan is flowing through it. History tells us that this process should take decades. For the United States, it took more than 50 years of 2 world wars, gold shipments from Europe, and the Marshall Plan. For China, that shift is starting in less than 20. 15 years ago, less than 1% of China's cross-border transactions were settled in yuan. Today, more than half are. In 2019, just 14% of China's own trade was conducted in its own currency. By 2025 this year, that figure has climbed above 30%. At the same time, Chinese banks have shifted billions of dollars worth of overseas loans out of dollars and into the yuan. It tripled the stock of yuan-denominated debt to more than $300 billion. This rise has accelerated after the United States sanctions on Russia. But under President Trump, the US dollar has been hit even further thanks to his erratic trade policy, his recent tax cuts bill, which will increase the United States government deficit by further trillions, and his constant threats to the independence of America's Federal Reserve. He's recently gone to ask the Supreme Court if he can fire the Fed Governor Lisa Cook after an appeals court rejected his decision to do so. No president has fired a sitting Fed governor in the agency's 112-year history. The closely watched Bank of America Fund Manager Survey just saw a sharp jump in the number of money managers, 26%, from last month 10%, saying that they're worried about the Fed's independence. This affects the dollar's rate, as it means that buyers think they cannot trust the Fed to make independent policies for the economy, which will safeguard the value of the US dollar. Investors are signaling that mistrust because they're pouring into gold, which has just hit record highs. It's a classic hedge against dollar weakness. The dollar's fallen by over 7% since January this year, and it's had its worst start to any year since 1973. Foreign investors are piling into the yuan as governments around the world look for dollar alternatives. For countries that rely heavily on dollar liquidity or fear Washington's sanctions, the appeal of diversifying currencies has rarely been stronger. By contrast, China's yuan has reached its highest level since Donald Trump was re-elected in November 2024. One of the clearest examples of this shift is Russia. After Western sanctions froze nearly $300 billion of its dollar and euro reserves in 2022, which were sitting in Western banks, Moscow accelerated the pivot. Today, more than 90% of trade between Russia and China is settled in yuan and rubles, compared with less than 30% before the Ukrainian war. Russian companies are issuing yuan-denominated bonds, and Russian banks are running yuan liquidity desks. And the Moscow exchange now clears more yuan than dollars. What began as a desperate hedge for Russia has become a financial lifeline. And survival trades have a way of turning into long-term habits. Despite Donald Trump's promise of uniting Russia and China, it's not going to happen. The Russians are not that stupid. Saudi Arabia tells a similar story. Since 2023, Riyadh has allowed Chinese oil refiners to pay for a part of their crude imports in yuan. The volumes are still modest compared with the entrenched petrodollar system, but the symbolism is powerful. Oil is the backbone of global trade, and China is the world's largest crude importer. The Saudis would have done a lot more if they were not so afraid of the American response, on whose military security they depend on. However, even a partial settlement in yuan chips away at the dollar's most guarded stronghold, energy markets. And if energy starts slipping out of the dollar's grip, history tells us everything else follows. Brazil's also shifted. In 2023, its central bank signed a yuan clearing agreement and began settling soybean and iron ore shipments directly in the yuan. For Brazilian exporters, the advantage is clear. It's less dollar risk and much faster settlement. For China, it deepens ties with one of the world's largest commodity suppliers. What began as a technical adjustment is now a financial bridge. It's linking Latin America's biggest economy much more tightly to Beijing. And remember, these countries are all major trading partners of China. The yuan they receive can be recycled directly into imports from China, avoiding the costs of the exchange of switching into and out of dollars. The earlier system basically created inefficiencies for them. Now, the yuan is allowing for a much cleaner, cheaper, and politically safer trade. For governments wary of Washington sanctions or simply tired of dollar's volatility, it is a compelling alternative. Now, I have done a whole series of videos on de-dollarization, so do check out that playlist, which actually looks at de-dollarization and what the dollar itself is doing, which is creating that. This is all about yuan. Now, all of this has not happened by chance. Beijing is setting up the structure of a new order. It's adopting a deliberate policy to internationalize the yuan as a strategy to insulate its own exporters from swings in the dollar, to blunt the threat of any future US financial sanctions, and to create that parallel financial order that is less dependent on Washington.
We have to talk about sanctions in 5 years because there'll be so many countries transacting in currencies other than the dollar that we won't have the ability to sanction them.
And it doesn't take Nostradamus to see that the US is preparing to isolate China as soon as it can. Now, Beijing has set up currency swap lines worth 4.5 trillion yuan, which is around 630 billion US dollars. China's building a safety net for dozens of central banks around the world, one that rivals the reach of the IMF itself. And this helps to globalize the yuan, especially in times of crisis. When countries' central banks need help, China will step in. The yuan currently accounts for only 4% of international payments, compared with 50% for the greenback. Similarly, 2% of global reserves are held in yuan, against nearly 55% in dollars. A lot of this is due to China's tight controls on money flowing in and out of the country, which has delayed the wider use of the yuan. But the direction is very clear. And when you compare this against the history of the dollar's own rise, you get to understand that yuan's progress to internationalization is much faster than many realize. Let's dive in deeper to understand briefly how and when the US dollar became the prime currency of the world, in which most of us have grown up under, and how China's yuan is taking over step by step. And it's a lot faster than you think. The United States overtook Britain as the world's largest economy by industrial output in the 1890s. After World War I, the US started to accumulate gold and became a major creditor to the world. The dollar's role in the international finance started growing quite rapidly between the 1920s and 1930s. But it took more than 5 decades, 2 world wars, UK government to run out of money, rebuilding Europe via the Marshall Plan, the transfer of Europe's gold to New York, and the creation of the Bretton Woods in 1944 before the dollar truly displaced sterling as the global reserve currency. In the Bretton Woods Conference, the dollar was formally established as that central currency of the international monetary system. Other currencies were now pegged to the dollar, which in turn was at that time pegged to gold. That institutionalized and accelerated the dollar's dominance. That's about 5 to 6 decades, roughly 50 to 60 years, before a clear dominance was established. But that world order is now breaking down. The dollar, which reached a high of 78% of foreign exchange reserves in 2001, the zenith point of its unipolar movement, has been coming down. Currently, it stands around 55%. That history matters because it shows that the economic size of a country alone does not instantly translate into financial dominance. China today is in a comparable position. It has nearly 20% of the world's GDP and around 30% of global trade. To become the world's reserve currency takes infrastructure, credibility, trust, and desire by the country. We only need to think about which country is gaining on those four factors and which country is losing out to see where China's going. By that standard, China's yuan is advancing at an unusual speed. And to see why, we need to look both at what Beijing has built and what weaknesses in the dollar it's exploiting today. The timing's favorable for China. In Washington, fiscal deficits have ballooned to over 7% of GDP. Remember the UK? Federal debt has crossed $37 trillion. And political battles routinely threaten government shutdown. We're currently in the midst of another potential shutdown as the political parties fight to get what they want approved. This is now a strategic move for China, and they think the time is right to make this move. China's leaders think a globally accepted yuan can help reshape the global monetary order and safeguard the country's own financial system. This makes it a matter of national security for them. It also ties foreign governments, firms, and investors much more closely to China. The strategy of financial tying, of course, works. We know that the Americans are the old masters at it. For example, Hungary is the most pro-Chinese country in Europe. Both countries have lots of financial and business ties together. More details on that later. In June 2025, China's central bank governor Pan Gongsheng declared that the global system was becoming multipolar. The dollar, he argued, would face competition from the yuan and others. The vision is not to topple the dollar, but to erode its singular dominance. Even if the yuan's share of reserves rose only to 10 or 15%, it would transform the balance of global finance. Now is a great time to do it, as that waning trust in the dollar and a supportive macroeconomic environment in China is helping to boost its efforts. For example, interest rates cuts have pushed borrowing costs in the offshore market to below 2%. This is the lowest level since 2013. And this has led to foreign and big Chinese corporates to issue a record amount of what are called dim sum yuan bonds this year. Traditionally, they would have raised dollar bonds. Now, dim sum bonds are yuan-denominated bonds which are issued in Hong Kong that foreign investors can buy. But it's not just offshore borrowing. Inside China, there has been what is a surge in what are called panda bonds. These are yuan-denominated bonds which are issued by foreign governments and companies directly into China's own domestic market. Hungary, for example, has issued a 5 billion yuan panda bond this summer. It's the largest sovereign issuance to date, worth around 700 million US dollars. The move was not just financial. It highlights how market access can reinforce political alignment. Hungary is already one of Beijing's closest partners in Europe, and it's vetoed EU criticism of China on multiple occasions. By tapping into China's bond market, it's further deepened those ties. Meanwhile, building on that trade shift, Russian energy companies are now also preparing their first panda bonds. And the Pakistani government is to issue one for $250 million as well. It's the first for the country. Countries like Kenya and Brazil are also weighing similar options. Together, all these offerings show that governments and firms are increasingly willing to bypass dollar markets and raise funding in China itself. A sign that yuan assets are becoming part of the global financial toolkit. China first attempted the yuan internationalization in 2009 after that global financial crisis. I remember that Lehman Brothers in 2008 was the reason why that financial crisis came about, and I was actually working at Lehman at the time. Now, one of the biggest issues that China faced at the time was that some of the capital controls were loosened and the yuan settlement in trade rose quickly. But that experiment ended abruptly in 2015 after a stock market crash in China and a surprise devaluation sent money fleeing offshore, as it does when you have these open capital markets. China responded at that time by reimposing tight controls. In retrospect, that setback also gave China time. Pushing too hard too early, might have provoked a sharper Western backlash. At a moment when China's economy was still maturing and its financial system was not yet ready to compete with the dollar. By slowing down, Beijing avoided making its currency a geopolitical target before it was economically strong enough to sustain the pressure. And the lesson was clear. Internationalization had to come only after China had built the depth, the liquidity, and the trade weight to support it. This time, officials are proceeding much more carefully. The strategy is to expand usage gradually, build the infrastructure for the yuan transactions, and ensure that foreigners have incentives to hold yuan assets. The push started on the domestic front through trade and payments. Over 30% of China's trade in goods and services is now done in its own currency, compared with that 14% in 2019. It settles more than 50% of its total cross-border receipts, including financial flows, in the yuan. And this is up from less than 1% in 2010. And globally, the yuan's share of international payments has doubled since 2022, reaching around 4% of the total. While this still lags far behind the dollar's 50% share, the rate of growth is striking. And we should also keep in mind, since a lot of the Chinese yuan trade is done outside the SWIFT system, this may actually be undercounting the percentage it actually has. In a push to further increase the circulation of the yuan, in May 2025, Chinese regulators told big banks that up to 40% of their trade facilitation lending should now be in yuan. Chinese banks have also shifted their overseas lending dramatically. Now, before 2022, only 15% of Chinese overseas loans were in the yuan. After Western sanctions cut Moscow out of the dollar system, new lending is now almost entirely denominated in the yuan. By 2025, more than 40% of outstanding overseas loans worth around $300 billion are yuan-based. And borrowers are happy, since they're getting below 2% rates, making borrowing much cheaper in the yuan than in many other currencies. As these markets deepen, global investors have more reason to hold yuan assets. Now, the change is not only financial, it also signals to borrowers, whether it's Africa or Central Asia, that access to Chinese credit will increasingly mean exposure to China's currency, not America's. Currency dominance is more than loans and trade. It requires infrastructure, the pipes and channels through which money moves. And China's now laid down much of that financial infrastructure, and many countries are already using it. First, CIPS, the cross-border interbank payment system. This is China's alternative to SWIFT. It already has over 1,700 banks worldwide as members, and transaction volumes have reached 175 trillion yuan, around $24 trillion. In 2024, it's seen a 43% increase year on year. Yuan clearing banks have now been set up, and they exist in 33 markets, including Turkey and Mauritius. Now, that reach makes it much easier for companies in Africa, the Middle East, and Southeast Asia to bypass dollar intermediaries altogether. These banks can now receive, process, and settle payments in yuan for other banks or businesses in its regions. The payments no longer have to go through the dollar or the euro, but can directly go between the two currencies of the two counterparties trading together. China's also set up a digital yuan, which is already in circulation domestically. They did this to hinder the rise of many cryptocurrencies which they could not trace in terms of buyers and sellers. But the digital yuan now makes it easy not to use dollars in trade. Similarly, they have a major project that's been developed through the BRICS platform, the mBridge project, a project which the Americans are very unhappy with. It's been developed in conjunction with the UAE, Hong Kong, and Thailand, and it's processed billions of dollars in transactions already. China's regulators have directed its own banks to increase their use of mBridge. And a US official recently admitted that it has already passed the threshold of geopolitical consequence. Together, these systems allow China to transact globally without relying on dollar-based networks. Another tool is the People's Bank of China's network of swap lines. As I mentioned earlier, since 2009, China has signed over 4.5 trillion yuan worth of bilateral currency swap agreements with 32 central banks. These arrangements allow foreign monetary authorities to obtain yuan in a crisis, and it ensures that they can settle trade or finance obligations. So far, only a fraction has been used, but the point is psychological. Countries know the liquidity backstop is there. In effect, Beijing's created a parallel financial safety net on a scale comparable to the IMF. And you can understand why this would strengthen the role of the yuan. History suggests it takes half a century for a currency to dominate. The US dollar needed a new world order after World War II before it became unchallenged. But today the world moves faster. Dollar trust is eroding, America's deficits are ballooning, and Beijing has already built much of that financial plumbing it needs for an alternative system. The yuan is still far from replacing the dollar, but it no longer needs to. It just needs to rise to that 10 to 15% of global reserves. The balance of global finance will look very different. For countries facing sanctions or simply looking to diversify, the yuan already offers a way out. And every time it's used to settle oil, to back a loan, or to anchor a swap line, the system tilts a little bit away from the Washington. Now the question is no longer if the yuan will matter, it's how fast the shift will come and how the world will adjust to this new financial order where money itself has more than one center of gravity. I'm Najma Minhas with GVS Deep Dive. Thank you for watching me and have a great day.